If you're investing in the stock market right now, this is an urgent warning you cannot afford to ignore. Today, we're diving deep into the potential market bubble of 2025 that could severely impact your portfolio. Does the current market situation look eerily similar to the dot-com crash of 2000, the financial crisis of 2008, or the corrections of 2020 and 2022? Most importantly, we're going to develop a practical strategy to protect your investments from potential downside risk. But here's the problem. Most investors are currently in denial, thinking this rally will never end. This analysis was originally part of a premium academy course, but I decided to bring it to the wider YouTube audience because this information is too valuable to keep behind a paywall. In the current market phase, understanding these data points is crucial because history tends to repeat itself, and only those investors who stay prepared survive major market crashes. At first glance, the markets look absolutely insane. Look at what's happened over the past 3 years. The Dow Jones is up almost 60% in just 3 years. This isn't normal growth, this is extraordinary. The S&P 500 has delivered approximately 90% returns in just 3 years. And the Nasdaq? It's jumped a staggering 120%. When you look at individual stocks, companies like Palantir and Nvidia have delivered thousands of percentage points in returns in just a couple of years. Any reasonable investor looking at these numbers would think the market is severely overheated and due for a massive crash. But here's where the story gets interesting. When we analyze historical data going back to the 1950s, a surprising pattern emerges. Out of the last 10 major bull runs, 7 of them lasted longer than 3 years. What's the average duration of a bull run? Approximately 5 years. We're currently only 3 years into this run, which means historically speaking, we're still ahead of the average curve. And check this out. Historical data shows that the average bull run delivers about 180% in returns. Currently, the S&P 500 is only up 87%. That means statistically, we're only at the halfway point, or about 3 out of 5 on the journey. So even though you might feel like the market is extremely overvalued and about to crash, historical statistics paint a very different picture. The S&P 500 has one simple pattern that repeats every decade. Despite short-term corrections, the long-term trend is always upward. Now let me share a famous case study with you. In 1996, Federal Reserve Chairman Alan Greenspan made a powerful statement. He described the market as experiencing irrational exuberance, meaning the market was getting unnecessarily overexcited without strong fundamental support. And guess what happened? Answer: the market did crash. But 3 years later, Greenspan wasn't wrong, but he was extremely early. From the time he issued that warning until the actual crash, the S&P 500 doubled from 750 to 1,500. This story teaches us a critical lesson. Being right isn't enough. Timing matters enormously. If you predict a market crash and sell all your investments, but the crash doesn't come for 3 years, you'll miss out on potentially 100% returns in the interim. Even Alan Greenspan, who was the most powerful financial figure in America at that time, couldn't perfectly time the market. So if he couldn't do it, realistically, it's almost impossible for average investors like us to achieve that precision. So the statistics look positive, but what is the macroeconomy telling us? Oh, are we getting any warning signals from that direction? Actually, macro indicators are presenting a mixed picture. GDP growth is decent, the economy is still expanding, job numbers are solid, although we're seeing slight declines recently. Inflation has stabilized at approximately 3%, which is manageable. The Federal Reserve is planning rate cuts, which is generally a positive signal for markets. Credit spreads are at their tightest levels since 1998, which is a legitimate concern. And the artificial intelligence sector is generating actual revenue. This isn't just hype. So from a macroeconomic perspective, we're not seeing strong signals of an immediate crash. Most indicators are in relatively healthy ranges. This is a completely different situation from the dot-com bubble or the 2008 financial crisis where there were clear warning signs. But now we come to the biggest concern: valuations. This is where the story changes completely. Currently, the S&P 500's forward price to earnings ratio is approximately 22.8 to 24. What's the historical average over 10 to 20 year cycles? Around 18 to 20. That means we're clearly trading above the historical average at approximately a 20% to 33% premium. And there's a specific pattern that's concerning. Historically, whenever the forward P/E ratio crosses 23, it's been a cutoff point. Above this level, market returns significantly reduce or can even turn negative. Here's the critical takeaway. If you examine historical data, entering the stock market when the forward PE ratio exceeds 23 has historically resulted in 0 or negative average annual returns over the following 10-year period. Look at the historical pattern. Whenever the forward PE crosses above that green line at 23, investors have been almost guaranteed not to make any money for the next decade. This is genuinely concerning. Currently, we're sitting at a forward PE of 24. So does this mean we need to immediately exit the market? Is this an absolute disaster waiting to happen? Hold on. Before we panic and sell everything, we need to consider some crucial contextual factors that make today's market fundamentally different from historical comparisons. For instance, the S&P 500 has never looked like it does today. We've never had 7 mega-cap companies so completely dominate the entire index. We might as well call it the S&P 7 at this point. Here's something fascinating. If you examine the equal weight S&P 500, where each company has the same influence regardless of size, the forward P/E drops to approximately 19, not 24. That's a massive difference. Additionally, we're experiencing stronger earnings growth percentages right now than we've ever seen before, higher revenue growth than historical norms, and better profit margins than previous market cycles. So if earnings quality and growth rates are superior to historical standards, we need to examine the PEG ratio because it accounts for not just the P/E multiple, but also the earnings growth rate. The formula is straightforward. You take the PE ratio and divide it by the earnings growth rate to determine if you're overvalued or undervalued. A PEG ratio of 1.0 means you're getting fair value. A ratio of 2.0 or higher indicates expensive territory, and anything between 1.0 and 2.0 suggests you're moderately expensive but not in bubble territory. According to Peter Lynch's methodology, a PEG ratio equal to the growth rate represents fair valuation. Currently, the PEG ratio for the S&P 500 stands at approximately 135. What does this tell us? We're positioned exactly in that middle zone that provides absolutely no definitive answer. Yes, we're somewhat expensive, but we're absolutely not in irrational exuberance territory. This is frustratingly inconclusive, so let me summarize where we are. We don't have a clear answer from P/E ratio analysis alone. We don't have a definitive answer from macroeconomic indicators. We don't have conclusive evidence from valuation metrics. We're stuck in this ambiguous zone where the data points in multiple directions. So what do we do? Well, perhaps we need to turn to the experts, the so-called market professionals and talking heads on mainstream financial media to tell us what's actually happening with this market. Surely they must know better than we do, right? Let's examine what the experts are saying, and you'll immediately see the problem. This is just a small sampling of expert opinions, and notice how they're saying completely opposite things. On one hand, we have bullish analysts claiming the bubble can push the S&P 500 all the way to 9,000. Then we have the head of JP Morgan warning that we face a major risk of a significant market crash. Then more prominent voices issuing crash warnings, but simultaneously, other respected experts are forecasting 7,000, maybe even 7,750 for the S&P 500, and then more dire warnings of an imminent crash. So we have multiple credentialed experts with completely contradictory predictions about where this market is heading. This provides absolutely no help whatsoever. So what we need to do here is eliminate all this noise. No opinions, no gut feelings, no conflicting expert predictions. We need a scientific test, a systematic approach backed by historical data. And that's exactly what I've developed in the Comprehensive Academy lesson on this topic. What I'm sharing today is a highlight of the main framework we discussed there. Through extensive analysis of historical market crashes, we've identified that most major crashes share 8 common elements. When all 8 of these indicators are present simultaneously, you're almost guaranteed to experience a market crash. Let me be clear, if all 8 indicators are present in 2025, the probability of a crash approaches certainty. If only 4 indicators are present, you're looking at roughly 50-50 odds. If none of them appear, you're likely safe to stay invested. Let's walk through these 8 critical tests systematically. Indicator number 1, extremely high valuations relative to historical norms. Number 2, rapid stock price appreciation over a compressed time frame. Number 3, significant surges in IPO activity, meaning initial public offerings flooding the market. Number 4, substantial increase in credit supply with excessive money flowing into the stock market through margin debt and leverage. Number 5, widespread market euphoria, where everyone from your barber to your dentist is talking about their stock portfolio. Number 6, lack of market breadth, meaning a very concentrated rally where only certain types of stocks are participating while the rest of the market lags. Number 7, low quality stocks with questionable fundamentals shooting to the stratosphere. And number 8, claims proliferating through mainstream and social media that the old parameters of valuations no longer apply because this time is different and this is the future. Now here's how the scoring system works. If we identify all 8 indicators as present, that represents a 100% probability of a crash. If we find none of these indicators, that's a 0% crash probability, meaning you should stay fully invested. And if we identify 4 out of 8 indicators, well, that's essentially a coin flip, a 50-50 probability. The key is to systematically evaluate each indicator against current market conditions and score our crash risk objectively, without emotional bias or relying on contradictory expert opinions. This scientific framework has successfully identified every major crash in modern market history when applied retrospectively. Now, let me be clear about something important. You don't need all 8 indicators to be present to make informed decisions. This framework is simply a tool for us to objectively evaluate where we currently stand in the market cycle. It removes emotion and bias from the equation and replaces them with historical data patterns. So let's systematically work through each of the 8 tests and see what the current data tells us. Let's start with the first and most fundamental test, valuations. I think we can all agree that valuations are definitely not cheap right now. As I mentioned earlier, the S&P 500 forward P/E ratio currently sits at approximately 22.8 to 24, depending on which data source you reference. The historical average over multiple decades consistently falls in the high teens, typically around 18 to 20. We're clearly above that benchmark. Let me put this in perspective. We're trading higher than we were in 2020 before the pandemic crash. We're higher than 2008 before the financial crisis. We're roughly on par with 2022 before that correction. And we're lower than the dot-com bubble peak, which hit a forward PE of approximately 33. So while we haven't quite reached the insane crash level valuations of 2000, we're definitely above 3 out of the last 4 major corrections. That's 75% of recent crashes. For me, it's straightforward to conclude that at least on the valuation front, this represents a genuine risk. This absolutely triggers a red flag, which means 1 out of 8 indicators is now confirmed. Let's move on to the second test, rapid price acceleration. Are we seeing a stock price surge over a compressed time frame? Right now, the S&P 500 is trading around 5,800 to 6,000. Over the past 6 months, we're up approximately 22%, which is roughly 4 to 5 times higher than the historical average. The normal 6-month return would be approximately 4% to 5%. We're at 22%. That's a massive deviation. And if you examine the 50-day moving average, the S&P 500 has traded above it for over 100 consecutive days, which represents the longest streak we've seen in more than a decade. When you analyze both the 3-month and 6-month performance metrics, they clearly tell us we're well above normal acceleration patterns. For me, this means another red flag. I'm not going to sugarcoat this or put lipstick on a pig. Yes, valuations are elevated, and yes, there's definitely rapid acceleration in share prices. So currently, we're 2 out of 2 on tests that are flashing warning signals. This is not encouraging. Now let's examine indicator number 3. Are we experiencing surges in IPO activity? Are more companies going public through initial public offerings right now? In Q3 of 2025, we recorded 64 IPOs, which means we're currently experiencing the strongest IPO market we've had since 2021. But here's the critical question. How do we compare to 2021 itself, which was clearly a bubble market that led directly to the 2022 correction? And this is where the important details emerge. We're still nowhere near the absolute insanity of 2021 that caused the crash of 2022. By October 2021, we had approximately 400 new listings. Right now, in October 2025, we're at 263 listings. That's a significant difference. In terms of capital raised, 2021 saw $142 billion raised by this point in the year. Right now, in 2025, we've raised approximately $32 billion. That's less than 23% of the 2021 levels. And if you examine first day performance, which measures euphoria around on new listings, 2021 saw an average first day pop of 32%. Currently, we're seeing 17% average first day gains. So when you calculate it all together, we're at approximately 43% of the 2021 situation. This means the market is warm, but definitely not boiling hot. This means there's no red flag here. I don't think anyone can credibly claim we're experiencing a massive surge in IPO activity right now based on this data, so this test does not trigger a warning. We remain at 2 out of 8 indicators triggered. Moving on to indicator number 4, increase in credit supply. Are banks willing to aggressively lend more money to the public? Are investors accepting lower yields in exchange for higher risk? Do we have a massive flood of money pouring into the stock market through leverage and margin debt? Once again, let's examine the actual data. Corporate bond issuance is up approximately 6% year over year. We have a high yield spread of 2.8%, which is very tight, but not at exuberant levels. So yes, it's getting warmer, but it's not reaching euphoric territory. Total loans in the United States are up 5% year over year. Commercial loans are up 8%, which is slightly on the high side. But again, it's getting warmer. Money is becoming more plentiful, but we're not in euphoric mode yet. Banks are not throwing money indiscriminately at people and companies. That's certainly not the case. Credit access is getting easier, but it's still not reaching insane levels like we saw in 2006 to 2007 or even 2020 to 2021. And yes, investors are willing to accept smaller yields as the tight credit spreads clearly demonstrate. But again, it's not completely out of this world. So for me, the verdict on this indicator is that conditions are easier and credit is more available, but we're not completely in euphoric mode yet. This remains a yellow flag rather than a red flag. So we're still at 2 out of 8 indicators triggered after completing 4 tests. Now let's move on to indicator number 5, euphoric sentiment. And I have to tell you, it certainly feels euphoric out there. If you spend any time on social media platforms, it absolutely seems like we're in full euphoria mode. But the critical question is, do we actually have euphoric sentiment based on objective, measurable data? Are we experiencing the classic shoeshine boy moment? You know, that famous story where ordinary people on the street are giving you stock tips and discussing their portfolios, signaling that everyone who could possibly invest is already fully invested. Let's examine the hard data. Right now, the AAII Retail Investor Sentiment Survey shows 46% bulls and 35.6% bears. The historical average for bullish sentiment is approximately 37.5%, which means we're definitely above average. However, the critical benchmark is pre-crash cycles, which historically have shown bullish sentiment around 60% or higher. Right now, we're nowhere close to that level. We're better than average, but we're not approaching crash level euphoria. And if you look at the CNN Fear and Greed Index, we're currently hovering in the moderate range, not showing extreme greed. There's nothing particularly euphoric right now, at least not on the retail sentiment side of things. That's precisely why we're not in the 2000 dot-com era yet, when everyone from taxi drivers to dentists was day trading tech stocks. Based on this objective data, we still have to say no red flag here, so we remain at 2 out of 8 indicators triggered after completing 5 tests. Test number 6, do we have a lack of market breadth? Essentially, are just a few stocks leading the entire rally while the vast majority of the market gets left behind? Right now, comparing the equal weight S&P 500 versus the traditional market cap weighted S&P 500 gives us a really clear picture. Does this situation only benefit the mega cap stocks, or is the rally broadly distributed? Well, here's what the data shows. Only 36% of stocks in the S&P 500 are currently trading above their 50-day moving average, which demonstrates that the majority of stocks are actually underperforming, while the S&P 500 has delivered approximately 22% year-to-date returns. The equal weight S&P 500 is only up about 8%. You can clearly see the massive divergence here. We absolutely have fewer stocks leading the charge. Right now, concentration at the top is extraordinarily high. It's undeniable. While it might appear that everything is running up and the entire market is participating, there are numerous stocks outside of AI, robotics, technology, or energy sectors that are being completely left behind. In my assessment, even though this could be considered a yellow flag because the situation isn't at 2000 levels yet, I'm going to take the conservative approach and count this as a red flag. We're now at 3 out of 8 indicators triggered on the conservative side. Now let's examine test number 7. Do we have low quality stocks, absolute garbage companies, exploding higher like they're the greatest innovation since sliced bread? And the answer is unequivocally yes. Stocks with fundamentally weak business models are absolutely blowing up right now. According to a recent Goldman Sachs survey tracking unprofitable companies, these stocks are up approximately 60% since April 2025. The same firm's analysis of the most heavily shorted stocks shows they're also up 60% since April. So all these unprofitable, heavily shorted companies, the ones that sophisticated investors are betting against, they've gained 60% in just 6 months. This is genuinely insane and represents classic late cycle behavior. Now, I've compiled a list of the top 15 best performing stocks of 2025 so far, and we conducted a detailed fundamental analysis of each company. We categorized them into 4 groups: strong fundamentals, weak but improving, mixed quality, and pure speculative garbage. The results are startling. Only 3 out of 15 stocks, just 20%, had genuinely strong fundamental metrics. Meanwhile, 6 out of 15, that's 40%, had absolutely terrible fundamentals by traditional measures. The vast majority of the best performing stocks we've seen this year are not particularly strong on the fundamental side. It's all about the narrative, the story, the future. It's largely nonsense from a fundamental analysis perspective. Now, I'm not claiming these companies will necessarily fail or that they're worthless. What I am saying is that the best performing stocks of 2025 so far have predominantly weak or mixed fundamentals. Only 3 out of 15 qualify as classically good companies from a traditional fundamental investment perspective. This absolutely represents a clear warning signal, so this is definitely a red flag. We're now at 4 out of 8 indicators triggered, so there's absolutely no doubt low quality garbage stocks are blowing up right now. Speculative companies with weak fundamentals are shooting into the stratosphere, and this test is definitely blinking red. We now have 4 out of 8 indicators triggered. Let's move on to the 8th and final test. The final test asks, do we have a prevailing narrative where traditional valuation metrics like P/E ratios, free cash flow, and profitability no longer matter? Is there a widespread belief that this time is different and the old rules don't apply anymore? Is everyone saying that fundamental analysis is outdated thinking and it's all about the narrative, the paradigm shift, the revolutionary future? If you examine the AI and cryptocurrency sectors right now, this narrative is absolutely everywhere. The conversation is entirely dominated by discussions of computing power, artificial intelligence capabilities, and revolutionary potential. We're in a situation where classic valuation frameworks have been completely thrown out the window. Nobody seems to care about traditional metrics anymore. Now, here's an important clarification. Maybe they're actually right this time. I'm not here definitively claiming they're wrong, because look, even in 2000 during the dot-com bubble, the internet revolution was genuinely real. The claim that the internet represented the future and constituted a paradigm shift wasn't incorrect. The internet absolutely did change the world, but what happened was that because this narrative emerged on such a massive scale, numerous fraudulent companies and opportunists jumped into the market. There was tremendous garbage mixed in with the genuinely great companies that have since transformed the world. So yes, I believe AI certainly has the same transformative potential as the internet, if not greater, but you will inevitably have enormous amounts of speculative garbage alongside the legitimate winners. However, that's not actually the relevant question for our test. The point isn't whether AI genuinely represents the future. The test simply asks, did we experience a narrative change where everybody is exclusively talking about the story and completely ignoring the fundamental numbers? That's the only criterion that matters here. And the answer is unequivocally yes. Right now, virtually nobody cares about fundamentals in these hot sectors. It's entirely about the narrative, the vision, the potential. This means we absolutely have a red flag on indicator number 8. We have a narrative break in favor of AI and cryptocurrency. And even if this narrative ultimately proves correct, even if AI does transform everything, it means that market participants have currently lost touch with fundamental analysis. This absolutely counts as a red flag, bringing our total to 5 out of 8 indicators triggered. Unfortunately, the verdict here is clear. We definitely have an elevated risk of a market bubble in the stock market right now. 5 out of 8 tests point us toward a 62.5% likelihood that we are currently in a bubble formation phase based on this specific analytical framework. Now, let me acknowledge the limitations of this methodology. This is just one analytical framework, and you could certainly run many different tests that might produce varying results. Additionally, this was an extremely close call. We were at 50-50 odds right up until the final test. So this is a borderline result, not a slam dunk certainty. However, we still have elevated likelihood, which translates directly to elevated risk. This means that even though we don't attempt to time the market and we don't make specific crash predictions, we absolutely must prepare because we do need to mitigate any risk risk we identify as a genuine possibility. Let me emphasize this critical distinction. We're not going to be predicting when or if a crash will occur. Instead, we will be mitigating risk. We will be preparing our portfolio regardless of whether we think a crash is highly likely or not. This is about prudent risk management, not market timing. Step 1. Disciplined buying and selling triggers. First, maintain your dollar cost averaging discipline at your normal pace. Don't panic and stop investing. Continue your regular investment schedule. Second, consider increasing your investment pace when quality stocks drop 20% or more below their 52-week high. This is when you're getting better valuations on companies you already wanted to own. Third, set 2 clear triggers to trim positions. Trigger 1, if any position grows beyond its designated portfolio weight, trim it back to your target allocation. Don't let winners become dangerously oversized. Trigger 2, if you have a stock that has dramatically outperformed without corresponding fundamental improvements, meaning the stock price is flying but the business hasn't actually improved, trim that position. Take some profits off the table. Only add top quality stocks to your portfolio during this elevated risk period. Narrow your focus dramatically right now to only companies that fulfill these strict requirements. Positive free cash flow for the past 16 quarters, 4 years, consecutively. Net profitability for the past 16 quarters consecutively. Revenue growth of 10% or better for the past 16 quarters. A clear competitive moat that protects the business. An exceptional CEO with proven execution ability. A strong management team across the organization. No major legal entanglements or regulatory issues threatening the company. This filter will dramatically reduce the number of potential investments. But that's exactly the point during elevated risk periods. Once you've identified companies that pass the quality filter, apply a rigorous scorecard evaluation. This scorecard has a maximum of 125 points and evaluates multiple dimensions of business quality. Financial strength, 10 points. If the company has more cash than total debt on the balance sheet, award 10 points. Net cash positions provide enormous flexibility during downturns. Revenue growth, 10 points. Consistent, sustainable revenue growth demonstrates business momentum and market demand. Operating margin analysis. This is tiered based on profitability efficiency. If operating margin is below 10%, award 0 points. The business isn't efficient enough. Between 10% and 25% operating margin, award 5 points. This represents decent profitability. Above 25% operating margin, award the full 10 points. This indicates exceptional business efficiency and pricing power. Short interest, 10 points. If short interest is below 5% of float, award 10 points. High short interest indicates that sophisticated investors are betting against the company, which is a negative signal during volatile periods. The complete scorecard continues with additional metrics evaluating valuation, management quality, competitive positioning, and growth sustainability. The goal is to identify companies scoring above 90 points out of 125, indicating truly exceptional quality that can weather potential market turbulence. Institutional ownership, 10 points. This metric evaluates professional investor confidence. If institutional ownership is below 30%, award 0 points. Institutions aren't interested. Between 30% and 60% ownership, award 5 points. Moderate institutional interest. Above 60% institutional ownership, award the full 10 points, indicating that sophisticated investors have thoroughly vetted and chosen to own this company. Revenue growth versus operating expenses, 10 points. This is a critical efficiency metric. If the company's revenue is growing faster than its operating expenses are increasing, award 10 points. This demonstrates operating leverage and scalability. The business model is working efficiently and becoming more profitable as it grows. 5-year stock performance versus S&P 500, 10 points. If the stock has outperformed the S&P 500 by 20% or more over the past 5 years, award 10 points. This demonstrates consistent value creation and management execution over a full market cycle. Competitive moat, 10 points. Does the company have durable competitive advantages? Network effects, switching costs, brand power, proprietary technology, or regulatory advantages? If a clear moat exists and is defensible, award 10 points. Without a moat, competitors will erode profitability. CEO quality, 10 points. Exceptional leadership matters enormously during market turbulence. Evaluate the CEO's track record, capital allocation decisions, strategic vision, and execution ability. Award 10 points only for truly outstanding leadership. Recession resistance, 5 points maximum. Does the business model hold up during economic downturns? Essential services, non-cyclical counter-cyclical revenue streams, and defensive characteristics earn points here. Maximum 5 points available. Secular growth trends, 5 points. Is the company positioned in long-term growth trends like artificial intelligence, renewable energy, healthcare innovation, or other multi-decade opportunities? Award up to 5 points for strong secular tailwinds. Culture and mission driven, 10 points. Companies with strong cultures and clear missions tend to attract better talent, retain employees longer, and execute more effectively. Award 10 points for exceptional organizational culture. Talent acquisition quality, 10 points. How good is the talent the company recruits? Are they attracting top-tier employees comparable to companies like Tesla, Palantir, or other elite organizations? Or are they hiring average talent? Award 10 points only for exceptional talent density. The total scorecard. Maximum 125 points. My personal cutoff threshold is 100 plus points. If a company scores above 100, it qualifies for portfolio inclusion during this elevated risk market environment. Below 100 points, the company doesn't meet the quality bar for new purchases right now. Remember this critical principle. Time in the market is the best friend of a great business. Scoring 100 plus points, and the worst enemy of an average one. Scoring below 100. During volatile periods, quality compounds while mediocrity gets destroyed. If you have positions that have become big winners where you've made substantial profits, trim them. There is absolutely no shame in taking profits. This isn't about being a loyal fan of the company. This isn't a religious cult where you must hold forever regardless of valuation or portfolio weight. If you have outsized winners, trim the position back to your target allocation. Yes, trimming winners often looks foolish in the moment, especially when that stock continues higher for another 6 months. But risk management always looks stupid until it doesn't, until the market actually pulls the rug out from under you. That's when you'll be grateful you locked in gains and maintained portfolio discipline. It is critically important not to hold unprofitable speculative garbage during times like this. I know these stocks are running up dramatically right now. That's exactly the problem. These speculative names with weak fundamentals would be the first casualties in any correction. This is absolutely not a good time to hold on to speculative trash, regardless of recent momentum. Cut your exposure to unprofitable companies, heavily shorted stocks experiencing short squeezes driven purely by momentum, and any positions based entirely on narrative rather than fundamentals. These are the highest risk holdings in a potential downturn. Implement these non-negotiable risk management rules immediately. First, never use margin. Eliminate all margin debt from your portfolio. Leverage amplifies losses catastrophically during corrections, and margin calls force you to sell at the worst possible times. Second, no concentrated bets right now. Avoid having any single position represent more than 10 to 15% of your portfolio, regardless of how confident you feel about that company. Concentration creates fragility. Third, no averaging down on cash-burning companies. If you own a company that's still burning cash aggressively and the stock drops, do not add to the position. Cash-burning companies face existential risk during market downturns when capital becomes scarce. Fourth, maintain 6 months of cash reserves. Always have 6 months of living expenses in hard cash or liquid equivalents. If the market pulls back sharply, you need to remain liquid and avoid being forced to sell investments at depressed prices to cover expenses. This cash reserve also positions you to buy quality assets at better valuations during corrections. Let me emphasize the core principles that separate successful long-term investors from those who get wiped out. Rule number 1, you do not win this game by timing the market. There is no reliable method to time the exact market top. Even the most sophisticated investors with the best information cannot consistently predict short-term market movements. Anyone who claims they can time it perfectly is either delusional or lying. Rule number 2, you win by buying quality companies and dollar cost averaging. Consistent investment in high-quality businesses at reasonable valuations maintained over long time periods is how wealth gets built. You win by having a disciplined system and following it regardless of short-term market noise. What 5 out of 8 means? Our analysis showing 5 out of 8 crash indicators triggered means we have identified elevated risk. It absolutely does not mean we panic and sell everything. It doesn't mean there's a guaranteed bubble that will definitely burst next month. What it means is we have elevated risk that must be mitigated and addressed, not ignored. Process beats prediction. always. This principle is fundamental to investment success. Having a systematic process for evaluating companies, managing risk, maintaining discipline, and responding to changing conditions will always beat attempting to predict specific market movements. It's very simple. Follow the process, ignore the predictions. The stock market in October 2025 presents a complex risk environment. With 5 out of 8 historical crash indicators triggered, we're facing approximately 60% probability of bubble conditions based on our systematic framework. This isn't a reason to panic, it's a reason to prepare. The investors who survive and thrive through market volatility aren't those who perfectly predict crashes. They're the investors who maintain discipline, focus on quality, manage position sizes intelligently, and have the liquidity and mental fortitude to buy when others are panicking. Implement the 7-step framework we've discussed today. Continue dollar cost averaging into quality companies. Trim oversized winners and eliminate speculative garbage. Apply strict risk controls. And above all, remember that your investment process is your competitive advantage, not your ability to predict the future. Stay disciplined, stay focused on quality, and stay prepared for whatever the market delivers. That's how you build lasting wealth regardless of short-term volatility. Thank you for watching, and I'll see you in the next analysis.